Hello, this is Mike Swanson of Wall Street Window. I'm speaking with Ike Iossif of MarketNews.tv, and we do frequent interviews of each other, but we're testing something out with Skype that might enable us to make the interview sound better. But anyway, we're just going to talk about two charts, and I wanted to show you something, Ike, that caught my attention today, and that's the chart of EGPT. That's the ETF for Egypt, and it's down 4.66% today. And what I think about this is it's interesting because we saw Turkey blow up last month, Argentina blew up, and now Egypt is down a lot today. And all of these countries are having sort of like crises, and all of them going into August had current account deficits over 5%. That's typically when countries eventually run into trouble, and Egypt was one of them. And I went and looked after Turkey blew up, and there's dozens of countries that have current account deficits around the world over 5%, but most of them are very small countries. People don't really think of them, or they don't really even have ETFs or stock markets. But Egypt was one of the bigger ones, and here we are watching it go down today. And this looks to me like a crisis in emerging markets that is, began in June and is just continuing.
Well, Mike, I will tell you something that does not come from me. Comes from a friend of mine. He's a money manager based in London, and we were having this conversation about a week ago. And he made an interesting analogy between the behavior of emerging markets versus major markets and the U.S. market, and what you see in the beginning of a bear market. And he told me this: he said, look, in the beginning of a bear market, the weakest stocks are the first ones to go. The generals are the last ones to go. And he goes, if you apply this on a global basis, the weakest markets in the beginning of a bear market are the ones to go first. In this case, the emerging markets. He goes, major markets, and the most important of all, the U.S. market, the general, so to speak, is holding up real well. So his thought was, globally speaking, not the U.S. market, but globally speaking, we are in the beginning of a bear market, and you're seeing the weakest markets blow up first, with other major markets, and last, perhaps, the U.S. market to follow, maybe anywhere between 6 to 12 months from now. That was his thought. To me, sounded interesting.
Well, let me ask you this about that kind of concept. Could that be applied outside stock markets? I mean, we obsessed so much about stock markets, but you have currency markets and bond markets, and I wonder if that concept could be applied to the bond market in the sense that the U.S. bond market could be seen as the strongest bond market in the world, even though it's off its highs, whereas Turkey and Egypt and these others are in horrible bond bear markets now, but the U.S. is the general of the world, basically, and maybe at some point it'll tip over and we'll have a global bond market, but we're far away from the U.S. bond market, collapsing or something.
Well, think about this. The 10-year, the yield on the 10-year for the U.S. is 3%. The yield for the 10-year for the Portuguese bonds is 2%. So I'm asking a simple question. Portugal is a country of 11 million people. The U.S., 320 million people, is the largest economy in the world. It is the most powerful country in the world with 13 trillion in GDP, and yet its bonds yield 1% higher than Portugal. What does that say? To me, it is revealing of the distortions the ECB has created in the bond market. In fact, the ECB has created bigger distortions in the European bond market than the Fed. The reason we're seeing the yield on the Portuguese bonds 1% below the U.S. bonds is because the ECB is buying Portuguese bonds, therefore suppressing the yield. Now the ECB is going to end this insane experiment at the end of the year. Once that happens, I do not know how smoothly or violently the European bond market is going to react, and also the global bond market, because I believe this insane experiment by the ECB, which was more insane than the experiment the Fed did, has distorted global bond yields. And again, I'm asking everyone if it makes any sense for Portugal to have a yield on its 10-year bonds that is 100 basis points below the US. It's nonsense.
Yeah, it doesn't make sense to me. But a lot of things in the markets don't make sense to me. Like what's been happening with gold, it's just dropped and dropped and dropped.
Well, talking about gold, let me share a chart with you, and I'll just have one point to make, Mike. Well, look at the XAU. It was at 240, went all the way down to 40. And from there, it had a sharp rally up to roughly 120, would back down to 60. So from 240 to 60, that's a loss of 180 points. Now, most bear markets, extreme bear markets, end with a loss anywhere between 85 to 95%. So that tells me gold stocks are more likely closer to a bottom than they are to a top. The question is, can the XAU fall further to 40? Yes, it could. And that would be a 50% loss. I mean, a 30% loss from where it's at now. It's quite a bit of a loss. But if you look at the big picture, we're already down by 80%. I just don't see gold stocks going down to zero. Now, if you believe that this can happen, okay, that's a different story. But what I'm saying is, at this point, we are near the top end of the bottoming range in an extreme bear market. And the bottoming range is between minus 85 and minus 95%. I don't think we're going to see a minus 95% in gold stocks. I don't think we're going to see a minus 90%. Okay? I think 80, 85 is more likely. So,
Well, if it fell about 80, 85%, about where on the XAU would that be?
well, from 240, okay, if you have a fall of 80%, okay, that's roughly about 190 points. Okay, so you will go back down to between 40 and 50, 55. We're at 60 right now.
Okay, that's not too much farther.
It's not. Of course, I want to remind everybody this. If you have bought, if you had an internet stock in 2000 that was trading at 100, and from 100 it went down to 15, and you bought it at 15, and then from 15 it went down to 10, it still went down 30%. Now from 10, some of them rallied up to 30 or 40, okay? So you would have had to endure a 30% paper loss before you realize a 100 or 200% gain. And it could very well be that this is the case with gold stocks. Like I said, I don't see the XAU falling below 40. I mean, from a value point of view, there is already quite a bit of value. That doesn't mean the bear market is over. Bear markets have the tendency to go to extremes. But even with an extreme case, you have a range. And as I said, between 85 to 95%, it's the most extreme of bear markets. I don't think we're going to see a 90 or 95% loss for the XAU or the QE. I think 80, 85% is pretty much the end. The thing is, as I said earlier, I want to point this out one more time. From 60 to 40, you're still talking about an additional 30% loss. 30% loss is not something to ignore. But if you look at the chart, it looks to me it's closer to the bottom than it is to another, 70, 80% decline. Because if you had a 70, 80% decline from current levels, what are we talking about? 10, 15 for the XAU? That's nonsense.
Yeah, it's something right. Oops. It's something I'm mostly just watching for now
Yeah,
because
no,
I'm not convinced it's turning around for good yet. But.
I agree with you. I agree with you. I mean, right now you're trying to catch a falling knife. There's no doubt about it. All I'm saying is, if you look at the chart, it looks that it's closer to a bottom. But that bottom could be 30% lower than where it's at right now. There's no doubt about that. I don't have signs that, gold and gold stocks have bottomed, but it could very well be that we are there.
Mm-hmm.
In fact, if you look at the XAU, look, the 60 level was a very important level because that was the 2008 bottom, and that was the 2014 bottom. So when it was violated in 2016, actually we violated a 7-year low. I mean, we violated a 7-year support, all right? The question is, the decline from 60 to 40, was it a bear trap? It could turn out to be. All this action between mid 2015 and late 2015, December 2015, maybe it was a bear trap. I'm not making this claim. We have to see it, but 60 was a very important support level going back to 2009. If it holds right here, that tells me the action the last 6 months of 2015 was just a bear trap. If we go further down, if we break down below 60, then probably 50, 40 is the next support level. But that I would consider as a double bottom because I just don't see gold stocks, let's say you, for example, going much below 40.
Well, one thing too, just looking at the chart, is if I forget about bottom prices and think of time instead, it would seem to me that regardless of whether it bottomed here at 60 or it's going lower, that it's going to take multiple bars on that chart before it goes up for good. Like in 2015, it spent months, above 40 basically, and so forth. So then to me, that's the key. It's more like this is probably going to take a couple months to play out.
Yes, technically speaking, I agree. The damage is quite a bit, and it does not get fixed in just 30 days. I mean, any technician will definitely agree with that.
But that said, I think I got to keep my eye on it, not just forget about it, because that's so often what people do in the markets. They just move on to something else and forget about it, and then things go up and without them, basically. So.
Well, if you look at gold and gold stocks, okay, beginning with the top in 2011, we have had a 7-year bear market. After 7 years of the bear market, people are exhausted. Okay, so the question is, if you're looking for opportunity, do you look for opportunity for a market that has been going up for 10 years, like equities, or do you look for opportunity in a market that has been going down for 7 years? I would look for opportunity in a market that's been going down for 7 years. It doesn't mean it cannot go down for another 1 year. Okay, that's why you have to keep an eye on it. I'm not saying this is the time to buy right now. What I'm saying is, if you are looking for a long-term opportunity to buy, where do you buy?
Well, and as we both know, when gold stocks go up, they really do go up. I mean, even the move in 2016 was tremendous.
Yeah, and again, look at the big picture. You have a bull market that has been going on for 10 years in equities, and a bear market in gold, and gold stocks have been going on for 7 years. If you're looking for value, where do you go?
Mm-hmm. Mm-hmm.
I want to repeat it. It doesn't mean gold and gold stocks have bottom right now. I'm not making that claim. All I'm saying is they are in the range where an intermediate bottom could be seen, a bottom that can hold for 1 to 2 years. I don't have confirmation of that. I'm watching it very closely. But if you're looking for an opportunity, if you're looking to buy low, you buy near the end of a 7, 8, 9 year bear market, not at the top of a 10-year bull market.
Mm-hmm. Mm-hmm. Well, we'll keep up to date on this situation, and thanks for talking to me and everyone else. And people definitely should go to your website, marketviews.tv, for more frequent updates from you and your paid services and everything. So thanks for taking the time to talk with me.
My pleasure.